rents are not likely to change. In years past, rents have increased significantly kind of across the country. They've pulled back a little bit, maybe in San Francisco, maybe a little bit in some of the major metros that just saw crazy rent growth. But I don't think we're going backwards when it comes to rent. What's up, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today I'm joined by my co-host,
Pierre Carrillo.
And today we're tackling a hot button issue of how interest rate changes are going to affect the housing market. So let's get into it. All right, Pierre, let's just jump straight in, man. Let's cut right to the chase. Interest rates are dropping. The Fed announced a couple weeks ago that they're cutting the federal funds rate by 0.5%, which is bigger than I think a lot of people expected. And so now everybody is on the edge of their seat saying, okay, what do I do now? How is this change going to impact mortgage rates or financing rates? So I'm just curious, at a high level, when interest rates drop by a little bit, and again, it's the Fed funds rate, that's not necessarily the mortgage rates, because those two things are semi-independent. They're related, they're correlated, but they're not the same. And so for anyone looking to get a little bit more clarity on how one impacts the other, definitely go check out our episode we did with Dan Frio. He explains all about this. But from a high level, Pierre, curious, if interest rates drop, where do you think the market is going from here?
My first question is, have we seen that drop in the Fed fund rate to affect mortgage rates just yet? I haven't been paying the closest of attention to this. Has this hit mortgage rates just yet?
It has. So I actually just went through a loan modification with my primary right now. And for anyone that's unfamiliar with the term, a loan modification is basically, hey, this is the current loan. Interest rates have dropped. I paid $1,000 and they dropped my rate by 0.75%. And that translates to about $500 a month in savings. So instead of going through the entire refinance process, the underwriting, the loan origination, all this stuff, because my loan is with a bank, they kept it on their books. It's on their balance sheet. They didn't sell it somewhere else. They said, okay, you're a great customer. We like you. You pay us $1,000. We're just simply going to drop your rate and then recalculate what your mortgage payment is. Still the same original amount. So even though I paid down some principal because I've had the loan for a little bit, same principal amount, they just changed the rate, and then that changes the payment. So it's a pretty cool thing if you have the ability to do it. So for anybody listening, reach out to your lenders and ask if you're able to modify your existing loans. Obviously, they have to be at a high enough interest rate for that to make sense. But it's a great tool to have in your tool belt. That's a fairly easy and often inexpensive way to get a better change in your rate. So that was a very long-winded way of answering your question, Pierre, of yes, I have seen that drop in interest rate in the Fed funds rate translate to in my opinion, a meaningful drop in terms of interest rates on mortgages. So the Fed funds rate dropped 0.5%. My mortgage dropped 0.75%.
So with that hitting the case, should we hop onto Zillow and see what home prices are doing?
Yeah. I mean, it's funny because like there's all of these different market factors, and you hear a lot about the market, quote unquote, pricing in these rate drops. And so well in advance of the actual Fed announcing this rate drop, we saw that getting priced into a lot of mortgages and to the stock market. We saw a pretty big bump in the stock market when the Fed announced that they were likely going to be announcing a cut in interest rates. So you see a lot of these things kind of being forecasted and already built in. And so it wasn't till in my example, in my case, where the Fed actually announced the drop, that then the bank turned around and said, okay, now we're going to drop our interest rates. Some banks got a little ahead of it, others less so. They waited till that actual announcement. So there's a lot of moving pieces, like you were mentioning. But I'm curious, like pick a side. I want you to pick a side, and then we'll chat through it. So with the rate dropping, do you think home prices, and again, it's super unique and location specific, but generally speaking, with this drop in interest rates, do you think housing prices are going to go up or down?
I would say that it's not going to have the biggest effect in the short term.
But which way, up or down?
Slight increase, I would
no
imagine.
Wrong answers in a brainstorm. You think it's slight increase?
Yeah.
Okay. All right. Tell me why.
So there's a lot of people who still have interest rates that are so far below what we're even cutting to right now. So that's not going to move them. Those who are waiting on the sidelines trying to get in, and the margin is this change in interest rate, I can imagine them flooding in. So I could see that there's not an incredible growth in the supply, but a moderate growth in demand. So, I would just say that it would be a moderate increase would be kind of my intuition, but I'm sure I'm not considering all the factors involved here.
No, that makes sense. I mean, that's economics 101, right? Supply and demand, where we have a slight increase in demand and a lesser increase in supply that then would drive up prices. And like you said, it's not going to be maybe massive, but we would expect that because the demand piece of the equation has gone up more than the supply piece. Is that what you're saying?
Yes.
Okay. All right. That makes sense. And I'm curious, like for anybody listening out there that has been waiting, whether it's to buy a primary or to buy an investment property, I'm curious, like, is there an interest rate number out there that makes you go from a no-go to a go? Or is it purely we're looking at the entire mathematical picture based on the particular house and the particular interest rate and your particular loan, which then dictates your price or monthly payment is X? Or are people thinking, once mortgage interest rates hit 5%, that's when I'm going to jump in, because it's more of a psychological impact than anything else. So would love to hear from anybody in the comments, where and how are you thinking about this?
I just imagine that it might even be, geographically specific, that we would see
it has
variance.
To be. Totally. Because think about like the different markets. So in the coastal markets, if your average home is $1 million, let's just pick a number here. Even a 0.75% interest rate change has a pretty meaningful and impactful impact. I don't think that's the right way to say it. It has a meaningful difference on your monthly payment, right? On an $800,000 loan, if you're using an 80/20, versus if we go to more of the center of the country, where your average home price is in that probably $200,000 to $400,000 range, a 3.25% delta on interest rate is just less dollars. There's less dollars swinging one way or the other. And that's not to say that's not a lot of money, but it becomes a smaller piece of the pie. And so I think it's hyper local and it's going to be hyper specific. But that's not the game we're playing today, man. We're playing the national umbrella game. So if you took the position of you think a slight increase, I'm going to take the counterpoint and go, I'm going to say it's going to be a slight decrease. And here's why. You make the great point of this lock-in effect where people are sitting on 3% mortgages. And if they want to move or maybe sell a property, they're giving up a 3% mortgage and then are going to have to go buy something else. Obviously, for this specific subset of people, those people that are selling and then are then going to turn around and go buy, they're giving up a 3% mortgage to then go get in to a 6.5% or maybe even a 7% mortgage. And for a lot of people, again, I think independent of the actual dollars involved, have a real hard time psychologically just getting over that. And I know because I'm one of them. I have a property that I was thinking about selling. I'm like, but the mortgage is 3.5%. It's not performing super well, but I'm like, that in and of itself is such an asset. I don't want to give it up. And so if there's anybody listening that can help coax me to get out of my own way, would love to hear from you. But because I fall into that category, I think that there are going to be people on the other side of the fence that say, you know what? No, I can get out of my own way, and I can get on board with a 5.5% mortgage or a low 6% mortgage if I'm giving up a 3% mortgage, because this new property is going to either perform better in the case of an investor or is going to be a better fit for my lifestyle if it's an owner occupant. And so I think just seeing this minor increase in rate is the first domino to fall, I would say. And I think that people who are thinking really forward looking think, okay, great. Well, I can sell this property today, go buy something at 6. And because I know interest rates are going to continue to fall, I want to be ahead of the curve if there is a change in prices. So if we get a bunch of people doing that, that then is going to increase the available supply. And I think supply and demand are going to come a bit more into equilibrium now. Which is going to drive prices down from where we've seen them.
Okay, so I know you're trying to do this as the national kind of umbrella, but can we do another breakdown here between kind of owner occupants and investors? Do you think that there would be a split in the way those two groups would behave?
Absolutely, I do. Absolutely, I do.
Tell me about that.
I think owner occupants are much more emotional and are making decisions based on how something feels or based on life circumstances, versus investors tend to think about things black and white and numbers. It either is or it isn't. And as an investor and as a homeowner, as an owner occupant homeowner, it's often hard to do one and not the other. And so I always joke, we've talked on the show before, when I went to go buy my very first primary, I was evaluating it like an investor. And I was like, Michael, shut up. Like, we're going to live here. This doesn't need to be an investment. I'm like, yeah, but it might one day. And so I couldn't take off my investor hat and put on my purely owner occupant hat. And that happens vice versa if I'm going to look at an investment property, which I think it helps keep me safe and it helps keep me in line. So I'm not necessarily I don't think that that's a negative. I actually see that as a positive. But in terms of behavior, I think that owner occupants tend to operate more based on, again, emotion and how that property is going to impact their life on a day-to-day basis. Versus investors, we're looking at the bottom line. How does the property perform? I'm less concerned with the carpet color or the paint color. I'm just, okay, these are the facts, these are the numbers, and this is the return that I'm in need of in order to execute on a deal. So that's what's going to drive that decision. The other piece that I think supports that argument is that rents are not likely to change. So we've seen in years past, rents have increased significantly kind of across the country. They've pulled back a little bit, maybe in San Francisco, maybe a little bit in some of the major metros that just saw crazy rent growth. But I don't think we're going backwards when it comes to rent. And so that then supports the purchase prices when it comes to investment properties. Because if the only thing that we're changing is interest rate, the price and the rent stay the same, that is actually going to support a stability or a slight increase in the purchase price that's able to be paid for an investment property. On the investment property side of thing, I think things are going to go up slightly. On the owner occupant side of things, I think we are going to have a big increase in supply. And people are going psychologically, are thinking, hey, you know what? Okay, we just saw this drop in interest rate. We can make a move now, right? And so that then unlocks this additional supply of properties that I think is gonna drive down costs.
Interesting.
What say you, good sir?
If you bought a property more than 3-4 years ago, however many years before that, you could have refinanced into this super low interest rate environment. If you bought after interest rates started to climb, I think most owner occupants aren't just living in their place for a couple of years. Like, these people are they're either trying to refinance and not move. It's kind of the more people who are opportunistic that would be trying to get out and move into a new place. So I just don't understand how we'd be seeing an increase in supply caused by a slight reduction in the interest rate.
Dang it, Pierre! Don't be so logical, man. I think you hit. I totally agree. I think you bring up a really great point, and that's, I think the crux of the question that we should be asking is, what is going to drive people to need to move? And is it a change in life circumstance? Is it a change in jobs? Is it expanding family? And that's the driver or the impetus. Most people don't sit around and go, "Oh, interest rates dropped. I guess I should move. I guess I should move."
Exactly.
Right.
We're looking to refinance. That's it.
Yeah. I think that makes sense. Do you think that there is a subset of the population, and baby boomers, I think is a good one to look at, because there are so many baby boomers that own homes that are now that are aging, that are going to need additional care, additional assistance. And so are they now more enticed to move because it's a purely price-driven decision, or are they going to stay in place and what they call age in place and have care and assistance come to the house? What do you think about that specific band of the population?
yeah, if you don't have to go buy into a new property and saddle up with a new 30-year mortgage at this higher rate, I can see that cohort of the population adding supply enough to make the trend in home prices go down. I don't know.
That's the $1 million question. If there's anybody out there listening that is expert in aging population trends and what they tend to do, please let us know. We'd love to hear from you. I think, and that's to the point, is like, we don't know the answer specifically, right? But there are a lot of variables and there are a lot of moving parts. But I think these types of questions are super important to be thinking about and cognizant of as you're making your decision, one way or the other.
Yeah, totally. To your point, I think that will be the case in specific geographic regions where the population is older. It could see an increase in supply there.
Yeah. Yeah. I love your point about Michael, the people that have high rates are just going to refinance. Like, they're not going to necessarily be moving.
Yeah, if we just moved into a house, like I'm that case, I'm that slice of the population who bought within the last few years and has a pretty high interest rate, and we are waiting for it to hit a threshold to go and refinance. But we would not want to move because, man, it's so much work, and we've kind of busted our butts making this house feel like our own. There's no drop in interest rates that would make me want to sell it.
But so to your point, so what's the drop in interest rate that you're waiting for? At what point does it become, quote unquote, worth it? What are you waiting for to go refi?
Well, a very wise friend of mine named Michael Albaum once told me that a single percentage would be the point. So no, I don't know. This is a conversation that I need to have with lenders. But yeah, I think we were waiting for that 1% to make it worth it. But you said something earlier that you were able to go in and speak to get a deal with the bank. I never considered that. So that might be a conversation worth having with our lender.
Totally.
But we were waiting for 1%.
Okay. All right. Yeah. As soon as we get done recording here, man, pick up the phone, go call your lender and ask if they can do a loan modification for you.
Very cool.
I'm curious, Pierre, one more question before we get out of here. This is on like the existing supply side of the equation. We talked about existing folks moving out or selling their home. What about in terms of new construction? Do you think that this drop in interest rate is going to spur builders to now start building new homes?
Geographically specific, yes. I know I'm just going to be a
the safest answer ever.
I mean, if I were an investor with, yes, I would say like, okay, there's going to be some more demand coming in. Let's match it, or let's meet it with some new supply. But I wouldn't do that in California, or I wouldn't do this in any city center or anywhere near like a large, heavy regulated Californian city.
Okay, so you see that because now there's been a drop in interest rate, that then you're thinking is going to translate to an increase in demand, which tells builders, okay, there's now people who are wanting to buy your product. We need to go build it. Did I understand that correctly?
That's my intuition, I would say. Yeah.
Okay.
I could be very wrong.
So. No, I think it makes sense. Like, I think it makes total sense. My question is, there's like a lead lag time, right? Between when a property gets started under construction between when it gets completed. And so let's say that's 18 months between the land development and the entitlements and all this sort of thing until when the finished product can actually get delivered and sold. And so how much do we think that this time impact is impacting the decision about whether or not to build? Because in 18 months from now, we're for sure going to have a new president, right? We're going to have new policies in place. Interest rates could be, who knows where they're going to be. So obviously, neither of us are builders. I did a development and got absolutely obliterated, so I cannot claim to be a developer. So how do you think people are forecasting and making these decisions about this kind of thing?
Yeah, I don't know what is caused. I haven't been following this super closely. Been just, life is so full. But is this interest rate drop occurring naturally? No, it's not. The Fed is doing it. But is the Fed doing it based off of a natural response to the market, or is this motivated politically by the upcoming election, and they want to, the current administration wants to bring things down as we go into election season?
Yeah.
What do you think?
Totally fair question. I I like to think that because the Fed is an independent regulated body, not controlled by the president, that
Supposedly.
it's totally independent. Right. Yeah, that's what we've been told. That's what I personally believe. But outside of that, like if we unplug that piece for just a moment and look specifically at builders, right? We get a drop in interest rate. Builders are now determining, okay, I need to bring new product to market, or does it make sense to bring new product to market? They have to forecast out from when the product is eventually going to be sold where we're going to be. Are we still going to be in a low interest rate environment, or will rates have gone back up and now that has now stifled demand?
Yeah. So I think I have an answer. If I had that kind of money to throw around on a development, I would really need to be much more involved in a market analysis than I currently am. But what I would be looking at is what is driving these current drops in interest rates. Are the fundamentals of the market the reason interest rates are coming down? Or is this a artificial drop by a governmental body? If it's the latter, by we're doing this for some political reasons or to ease the economy for people, I would not build, because if it's an artificial drop, I think that's unsustainable and we will see them climb back up. So during that building time, we could see them, climb up to even higher than what they might be now. So that would
versus
be
if it's
my thought process.
If it's a fundamental decision, the market is demanding this, that supports then building.
Yes.
Got it. Awesome. Well, hopefully this was helpful, everybody. I would love to hear any questions, comments, thoughts that you have on the episode, since clearly this is on everybody's mind and we are not the experts by any means. As always, we'd love to hear from you, and we look forward to seeing you on the next one. Happy investing.
Thanks, everyone.